So Royal Orchid Hotels just dropped their latest numbers, and on the surface they look incredible, but when you start to dig in, that's where the real story is. We're talking huge growth, a brand new hotel that's an absolute star, and some pretty interesting accounting. So yeah, let's get into it and unpack what's really going on with their big expansion plans.
All right, here's what we're going to cover. We'll start with their great quarterly numbers, and then we'll talk about the huge impact of their new hotel, Iconica. After that, we'll break down what their whole asset-light model is all about, take a peek at the hotels they've got coming up, and finally, look at their huge goals for Vision 2030.
All right, first things first, let's talk about the headline numbers for this quarter, Q3 of fiscal year 26.
And wow, they really knocked it out of the park. We're looking at some seriously strong year-on-year growth, pretty much everywhere. I mean, income from operations, up almost 27%. Room revenue, that shot up by a massive 45%. And maybe most importantly, their EBITDA, which is a great way to look at profitability, grew by nearly 33%. That tells you they're not just making more money, they're also being smart about their costs.
And look, this isn't just some lucky break. The company's chairman, Chandra Balji, even said it himself. He called this a major milestone in their plan for disciplined growth. That phrase is key, because it really sets the tone for everything else they're up to. This is all part of a very calculated strategy.
So you might be asking, what exactly drove all this incredible growth? Well, a huge chunk of it boils down to one single thing: the launch of their amazing new flagship hotel in Mumbai, called Iconia. Get this, in just its first few months of being open, Iconica pulled in a staggering 17.4 crore rupee in income. I mean, for one brand new hotel to do that right out of the gate, that's pretty wild. It just goes to show you how much power this new brand has.
And it wasn't just about the money either. Think about this. Within 4 months, just 4, it became the #1 ranked hotel in all of Mumbai on TripAdvisor. That's insane. It tells you that guests absolutely love the place, and the brand is incredibly strong from day one.
Okay, but hold on. Here's where things get a little weird. If you dig into the details, you'll see the hotel actually reported a small loss for its first quarter. So what's up with that? How can a place be so popular, make so much money, and still not be profitable?
Well, the answer, as it often is, comes down to accounting. See, the hotel had a bunch of one-time startup costs. They call them pre-operating expenses. It was actually supposed to open way back in the summer, but there were some licensing holdups, so the big launch got pushed to November. The accounting rules say they had to write off all those early costs right away, which created a loss on paper. So the key takeaway here is this had nothing to do with how the hotel was performing. It was just a one-off accounting thing.
And you know, this whole story with Iconia fits perfectly into their bigger picture, their main strategy. It's all built around this idea of an asset-light model. And honestly, if you want to understand how they plan on growing so fast, you have to understand this concept.
So what does asset-light even mean? Well, it's pretty simple actually. Instead of buying the super expensive buildings and land themselves, they just focus on managing and operating the hotels for someone else who owns the property. This lets them grow their brand and open new hotels way faster without needing a mountain of cash.
And they basically do this in 2 different flavors. First, you have the management contract. In this deal, the building owner takes on all the financial risk, and Royal Orchid just gets paid a fee to run the place. Super stable, low risk. But then you've got the revenue share model. This is where Royal Orchid takes on the risk. They're responsible for the profit and loss, and in return, they just pay the owner a slice of the revenue. It's definitely riskier, but the potential upside, the reward, is way bigger. And that Iconica hotel in Mumbai, yep, that's a perfect example of this high-risk, high-reward approach.
Okay, so this leads us to the next big mystery in their earnings report. Even with all this record-breaking revenue, their overall earnings per share, the EPS, actually went down by 40%. How on earth does that happen?
And you guessed it, the answer is accounting again. There's this specific rule called Ind AS 116, and it basically forced them to record a huge on-paper expense, it's called a notional charge, of around 12 crore rupees. This was all tied to the long-term lease for the Iconica property. So the important thing to remember is that their actual cash profits were totally fine. It was just this accounting rule that made the final number on the page look way worse than reality.
Okay, so now that we've got the strategy down, let's look ahead. Because with this asset-light model firing on all cylinders, their pipeline for new hotels is, well, it's absolutely massive.
And we're not talking about a few small hotels here and there. They have 4 huge new properties coming online using that high-reward revenue share model. We're talking about a hotel in Lucknow that's expected to bring in 40 crores, another in Gurgaon for 25 crores,
and 2 in Goa that should do about 22 crores combined. Add all that up, and you're looking at almost 90 crores in new revenue just from these 4 hotels.
But wait, it gets even crazier. On top of those big 4, they have more than 47 other hotels in the pipeline, and they're all scheduled to open in the next year to year and a half. I mean, that just shows you the insane power of this asset-light model to scale up at an incredible speed.
So all of this crazy fast expansion, it's all leading up to something much, much bigger. It's part of their grand plan, which they're calling Vision 2030.
And let me tell you, their goals are not small. By 2030, they want to more than double their size to 22,000 rooms. They're planning for 8 of those flagship Iconica hotels. The whole idea is to become the tech-savvy, asset-light leader in the space. They're not just trying to grow, they're trying to completely reshape the future of hospitality in India.
So that's where we're at. Royal Orchid has this crystal clear strategy. They've got a new brand in Iconica that's already a proven winner, and their pipeline is just enormous. But turning that plan into reality, opening that many hotels and doubling your size, that is a huge, huge challenge. So the big question we're left with is, can they actually pull it off?
Okay, so picture this. You walk into a room and it is just dead silent.
Right.
But not the peaceful kind of silence. I mean, the kind where everyone is holding their breath.
Yeah, the air is thick.
Exactly.
Yeah.
You know something is about to happen, like someone is going to shout or a fight is going to break out. But for this one specific second, nothing is moving at all.
That is a very cinematic way to start a Monday deep dive.
I try my best.
But looking at the data we have today, you are actually not wrong. That is exactly the vibe.
It's totally the vibe I'm getting.
Yeah.
So welcome back to the deep dive. Today isn't about big philosophical concepts or global macroeconomics. We are zooming all the way in today.
All the way in.
We have a single artifact on the table for you. It's just a screenshot. A single comprehensive daily candlestick chart from a mobile trading platform. Nuvama, to be specific.
And to set the scene for you, it is Monday afternoon, February 23rd, 2026. The Indian markets have just closed, and the artifact we are looking at covers roughly October 8th, 2025, up to just a few days ago, February 20th, 2026, and it's for Royal Orchid Hotels Limited.
Ticker symbol ROHLTD on the National Stock Exchange, or NSE.
Precisely.
And our mission today is simple. We are going to decode this visual noise because to the untrained eye, it just looks like a bunch of red and green sticks and some squiggly lines.
A lot of squiggly lines.
Yeah, but you've been telling me that this specific chart, right at this specific moment, is a textbook example of a stock struggle for stability. It's a story.
It really is. It's a perfect storm of technical signals. We are not just looking at lines, we're looking at market tension.
Okay, so what's the roadmap here?
We are going to peel it back in 3 layers. First, we have the price action, which is the physical candles themselves.
The trauma, basically.
Exactly, the history of the decline. Then we have volatility, which is visualized by these green lines called Bollinger Bands. And finally, momentum. We'll use the RSI for that. And when you stack those 3 things up, that silence you mentioned earlier, it is deafening. Let me give you the exact current context. The closing data point from today, February 23rd. The stock closed at 363.85.
Which is down slightly from its open today of 364 point visa.
Exactly. So let's start with the price action, because if you look at the left side of this chart,
It is yikes. That's the technical term, yikes,
it is a crime scene. Let's rewind to early October 2025.
which is where the chart begins.
Right. Life looked pretty good for Royal Orchid shareholders then. Look at the y-axis. The stock is trading in a significantly higher range.
Way up in the penthouse. It touches heights above 511.50.
511.50. It was testing highs, but then gravity took over.
And it took over fast. I mean, if you look at October and November on this graph, it is just a sea of red candles dominating the screen.
And for anyone who doesn't stare at charts all day, a red candle simply means the stock closed lower than it opened. The sellers were in control.
And here they were in control for weeks. This really steep downward slope.
A massive percentage of its value just wiped out. It drops from those 500s all the way down to the 309 level.
309. That is the visible floor on the y-axis here.
Yeah.
So from 511 down to 309, that's a brutal fall.
And that brings us to the daily details, the daily grind of what this stock is experiencing right now.
Well, let's break down the specific numbers for the final candle shown on this chart. What does a trading day actually look like for ROHLTD right now?
Well, as we said, the open was 364.90.
Okay.
It went to a high of 367.9. The low of the day was 362.40. and it closed at 363.85.
So the most recent candle is just small and red.
Very small.
It indicates a day of very, very tight movement. The price closed just slightly lower than it opened.
Yep.
It really reinforces this current trend of total stagnation.
It's a stalemate. The buyers and sellers are just staring at each other.
Which brings us to layer 2, visualizing that volatility. Let's talk about the Bollinger Band.
Right, the green lines.
Yeah, I love the name. It sounds like an indie rock group. But focus on the 2 green lines enveloping the price candles here.
So during that crash phase, we just talked about the steep drop in November. Look at how those bands were behaving.
They were wide apart, like a massive river.
Exactly. They're wide apart, and the price candles were basically hugging or actively pushing against that lower band.
Like trying to break through the floor.
That indicates extreme downward momentum and extremely high volatility. The market was in panic mode.
But now let's contrast that with the right side of the chart. Looking at January and February 2026.
It's completely different.
The bands have narrowed significantly. It's like the river became a tiny stream. The price is now just floating in the middle, roughly equidistant between the upper and lower bands.
We call this a squeeze.
Squeeze.
Yeah, this narrowing visually represents a massive reduction in volatility. The market has moved away from the panic of the drop.
And into indecision.
Exactly. It's just a sideways drift around this 363 to 376 range.
So the bands are squeezing the price. But does that mean it's going to stay flat forever?
No, actually it means the exact opposite. Volatility is cyclical. A squeeze means energy is being stored up. The bands will eventually widen again.
Okay, so the tension is building, which is a perfect segue to our third layer.
Yeah.
Momentum and strength. Let's shift our attention to the lower graph.
The line graph in the middle panel.
Right, labeled RSI 14, Relative Strength Index.
So let's look at the historical context first. See that deep V shape in the RSI line?
Oh yeah, back in November. During the absolute bottom of the price crash, the RSI dips way below the 30 mark, which is visible on this scale here.
When it drops below 30, we define that as oversold territory.
Meaning the panic selling was just too extreme.
Right, it was unsustainable, which is why you see the recovery right after. Trace the RSI's climb in December.
It shoots straight up.
It peaks near the 70 line.
Which is overbought territory. The stock briefly rallied and people got a little too excited.
Exactly. But let's look at analyze the current reading for us.
Okay, looking at the far right, the RSI line is hovering right around 48.50. I mean, on a scale of 0 to 100, that is pretty much dead center.
The verdict on 48.50 is that it's absolute no man's land.
No man's land.
It is almost perfectly neutral. It's midway between 0 and 100. And what this does is it confirms the complete lack of a strong trend in either direction right now.
Neither the buyers nor the sellers are in control. It's just perfectly balanced.
Balanced but tense because of the squeeze.
Right. So we have flat prices, tight bands, and a neutral RSI. Is there anything that can tell us who is going to win this tug of war?
Well, for that, we have to look at volume analysis. We need to ask, where is the conviction?
Let's examine the volume chart at the very bottom of the image then. The bottom bars.
Notice the panic spikes first.
Yeah, back in late November and early December. There are these really tall vertical bars, green and red.
That suggests that the heavy price drop was accompanied by incredibly high trading activity.
A mix of panic selling from people giving up and aggressive buying from people trying to catch the bottom.
Exactly. High volume means high participation. People cared. But now, contrast those massive spikes with the volume bars we are seeing right now in February 2026.
They're significantly shorter and super uniform, just tiny little nubs all in a row.
So when we synthesize this, the interpretation is clear. Low volume combined with flat price action equals a wait-and-see period.
The big market participants have just stepped back.
Yes, they are sitting on their hands. They are waiting for a catalyst to drive the price out of this 360 to 370 zone.
They aren't going to commit real money until the stock proves which way it wants to go.
Right. No one wants to be the first one to blink.
So let's summarize the journey of this chart for everyone listening. We started with Royal Orchid Hotels taking a major fall from up above 511 down to a floor of roughly 309.
Painful drop.
Then we had a brief recovery in December that completely ran out of gas. And that has now stalled into this tight sideways consolidation right at 363.85.
And when you connect the squeeze and the Bollinger Bands with that perfectly neutral 48.50 RSI, you get this feeling of a coiled spring.
The market is compressing.
Compressing tightly. Every day the volume stays low and the price range gets tighter. That spring winds up just a little bit more.
Okay, so I want to leave you with a provocative thought based on all this visual evidence we just went through. When a stock flatlines like this, with basically zero volume and narrowing bands after a massive crash,
Yeah.
is it actually building a solid base for a true recovery? Or is it just taking a breath because it's exhausted before falling even further?
That is the million-dollar question.
Because the chart absolutely shows the tension,
Yeah.
the silence we talked about at the beginning. But it purposefully does not show the direction of the break. You have to wait for the snap.
You have to respect the silence. Don't assume stability is safety. Sometimes it's just the pause before the next drop.
Exactly. So for everyone listening out there, open up your own platforms, look at your own portfolios, go look for squeezes in your own charts. See if you can spot the tension before the snap happens.
It's a great exercise. You start seeing these coiled springs everywhere once you know what to look for.
Yeah, you really do. Thanks for joining us for this deep dive.
My pleasure.
We will see you all next time.